afternoon, Your Excellencies, ladies and gentlemen, distinguished guests. My name is Dan Chapman. I'm the founder and CEO of Argentum Creek Partners. Great pleasure to be here with you today. Argentum is an EM hedge fund focused on investments in restructuring, special situations, and distressed. We started our business in 2015, a result of a spin-out from Cargill, but our roots go way back. We've been investing in emerging markets for 30 plus years. First on the sell side with JP Morgan, and then on the buy side with Black River Cargill Unit and ACP. Today we have a impressive lineup of speakers here for you today, covering buy side and sell side, as well as legal, financial, and advisory firms, on the investigative front and advisory firms. So investing in special situations, restructuring opportunities, it's a multidisciplinary approach. And I expect the benefit of listening to these advisors and professionals that we have here today will leave you with a great deal of knowledge about the opportunities and how to navigate these opportunities in current environment. Before I begin, I'd like to thank our friends at ADGM for organizing this event and bringing these thought leaders across these disciplines and sectors, regions, to address the broad spectrum of issues that are creating this opportunity and awareness around restructurings and turnarounds. I'd also like to thank our partners at Abu Dhabi Investment Office. Grateful for their support and guidance. It's been an integral part of accelerating Argentum's expansion into the region, where we just opened an office here in ADGM. Now, let's turn to why we're here today, EM restructurings, what lies ahead. I think we can all agree that the world today is a different place than where we were a year ago. But going back a dozen years or so, as a financial investor, the world of risk has changed a lot since the global financial crisis. Recent trends are quickly unwinding, and some of those changes are having a profound effect on markets today. Historically speaking, the global financial marketplace is inherently volatile, unstable, basically a two-way bet. But with recent interventionist policy across various different governments, the marketplace is operated with more of a sense of stability, a buy-the-dip mentality, which has been the case for quite some time. But now the tides are changing, and I think we all need to pay attention to what's going on. The transition to the new financial environment of higher costs, inflation, interest rates, combined with increasing geopolitical conflicts, requires careful navigating. Generally speaking, the 08-09 GFC has been considered a benchmark period for major distressed opportunities in EM over the past few decades. In our view, we may be seeing today an opportunity that rivals or exceeds the GFC, which was a time that generated great returns for distressed investors. Post-GFC, we've seen trends in the markets driven by government policy, so stimulus, historically low interest rates set by central banks, low inflation, and this has resulted in an unprecedented increase in the level of debt, corporate debt issuance, and outstandings. Let me see if I can get this. So a chart can say a lot more than words, so I'll pull up. Okay. So the chart you see here is a simple chart about EM corporate external bonds outstanding and how that's grown since 2004. The chart shows hard currency bonds only. While this is a subset of the overall amount of debt in emerging markets, corporate debt in emerging markets, we view this as a reliable data set that shows bond specifics, but indicates overall EM debt trends of all types. So the space is much larger than you see here, but this data is very indicative of what's happened overall. So when I started my career, my EM career in sort of prehistoric times, 1989, there were almost no EM bonds. We were trading sovereign loans. Most of them were defaulted at that time. But in 2004, when I started my career on the buy side, which is where this chart starts, the corporate market was about $250 billion face value of outstandings. Leading up to the GFC, we had impressive growth. So market size doubled between 2004 and 2009. And then the stimulus-fueled explosion of debt happened post-GFC. We're now, from the GFC 2009 to today, at $2.6 trillion of outstandings just in hard currency bonds, 5 times the outstandings prior to the GFC. It's a big number. I think you should take a moment and let that sink in. So it's also important to note, while that number is large, 40% of the debt that of these outstandings, those mature in the next 3 to 4 years. That is a significant challenge, I think, to many of these corporates in emerging markets. It's our expectation that while defaults have been elevated, we're going to see more defaults. Overall levels of EM distress already exceed what we saw in the GFC in terms of quantum. But with the debt stock as big as it is today, we believe that is far from over. Successfully navigating these periods of transition and turmoil can be extremely attractive opportunities for investors. So while this sounds challenging, it's not all bad news. There are a range of positive things to note. For example, overall net leverage metrics are actually down materially from the COVID peak for EM high-yield issuers. The amount of net leverage in an EM high-yield issuer is about half that of U.S. issuers, and about 1/3 of that of European high-yield issuers. So this, we think, may indicate a future access to credit problem rather than a solvency problem. That's a classic baby with the bathwater type of trade. That's usually a good trade to do in emerging markets. Secondly, on the legal and regulatory front, we feel like regimes have generally improved in many jurisdictions since the GFC. That means tools for recovery are stronger, and therefore restructuring prospects are better. Lastly, some places are actually doing well in this environment. The GCC is a good example. As we've seen here this week, Abu Dhabi specifically is thriving, proactive and dynamic strategy, and we feel like in a position to benefit. So there are winners and losers. There are also a lot of challenges. In my experience, a healthy dose of skepticism is a way to survive in emerging markets over the long haul. And as we transition to the panels, I think a questioning mindset is important. And here are some of the questions I keep in mind. I'm sure there will be many more that I hope you all ask of the panel and they'll have for us. But firstly, how will rising interest rates and inflation with the specter of a recession impact EM? Are we in for an epic default cycle? Secondly, is the strong USD a major problem for emerging markets? Will higher risk-free rates crowd out emerging markets borrowers and create a home country bias? If you can invest in a US Treasury at 4%, do you really need to go to EM? Geopolitical risks, food security, energy security, the impact on emerging markets. How do you navigate this? And is globalization reversing? The jury is out on that. Finally, expanded use of sanctions. The sanctions as a weapon, frankly. How does this impact EM borrowers? And how do investors navigate this? Tough question. Active management. In this environment, can index and passive investing work in emerging markets? Do we need more specialization to navigate these complex situations that we face? These are just a few questions to get us started. I look forward to hearing from the panel on these and others. This afternoon, we hope to address these questions, but also benefit from lessons learned by this highly experienced panel. Many of these folks, I'm very interested to hear what they have to say. We've worked with many of them. Key to our success is having a great team. Our team is Argentum, and a lot of the folks you'll see here today. So I look forward to hearing the panels, and hope you're excited as I am to get on with the day. Enjoy the rest of the conference. Thank you.